Stop scrolling right now because what I discovered in the silver market this week could change how you think about precious metals for the rest of 2026. I spent the entire week tracking data that most analysts completely ignore. And by Friday, I realized something that genuinely surprised me. But before I reveal what I found, I need you to understand why this matters to you specifically. Today is Saturday, January 24th, 2026, and you're watching Boring Currency Info. Now, let me be absolutely clear from the start. Everything I share in this video is purely educational analysis. This is not financial advice. Silver markets carry significant risks, and prices can move against your expectations without warning. My job is to help you understand market dynamics so you can conduct your own research and make your own informed decisions. With that said, let me take you through this week day by day, because the story that unfolded is fascinating. Monday, January 20th, was Martin Luther King Jr. Day in the United States. American markets were closed. Now here is what most people assume. They think nothing important happens on holidays. They take the day off from watching markets. They check back Tuesday morning. But I have learned something over years of studying markets. Holidays often reveal information that gets hidden during normal trading. Why? Because when American traders step away, volume drops significantly. And in thin markets, the behavior of remaining participants becomes more visible. Think of it like a crowded room versus an empty one. In a crowded room, individual movements get lost in the chaos. In an empty room, every movement stands out. On Monday, Asian and European markets remained open while America slept. Silver traded in a narrow range, which seems unremarkable until you notice the premium that developed in Asian physical markets compared to paper prices. This premium was small, just enough to catch my attention, but not enough to make headlines anywhere. I wrote it down and moved on. But remember this detail, because it connects to something I will explain later. Tuesday morning arrived, and American traders returned to their screens. Now watch what happened next, because this is where most people made their first mistake of the week. The opening hour was notably active. Volume exceeded the previous week's Tuesday open. Within just 2 hours, silver tested both the upper boundary and lower boundary of its recent trading range. If you were watching in real time, this probably felt chaotic. Price moved. Up, then down, then back up. Many traders I follow online expressed frustration. They wanted a clear direction. Instead, they got noise. By afternoon, everything calmed down. Price settled into what technical analysts call consolidation. Most traders saw this and immediately lost interest. They went looking for excitement in other markets. And that was their mistake, because here is something experienced traders understand that newer traders often miss. Consolidation is not the absence of opportunity. Consolidation is preparation. Markets consolidate before they move. The tighter the consolidation, the more powerful the eventual breakout tends to be. So, while most traders dismissed Tuesday afternoon as boring, I was paying closer attention than ever. Now I need you to lean in for this next part, because Wednesday, January 22nd, contained the single most important development of the entire week, and almost nobody noticed it. On the surface, Wednesday looked like nothing. The daily candle was tiny. Price moved in the smallest range of the week. If you checked your charts that morning and then checked again that evening, you might have thought your screen was frozen. Nothing seemed to happen. But here is what actually happened. I pulled up the volume data for Wednesday and compared it against the 20-day average. Volume was elevated, significantly elevated. Now think about this carefully. Price barely moved, but trading activity was high. What does this mean? It means large players were active in the market, but they were trading in a way that did not push prices dramatically in either direction. In market analysis, we call this accumulation or distribution, depending on whether these large players are buying or selling. When institutions want to build large positions, they cannot simply place one giant order. That would move the market against them immediately. Instead, they accumulate slowly over time, buying in pieces, absorbing whatever selling comes their way without letting price run up. Wednesday's volume pattern strongly suggested this type of activity. Retail traders scrolled past Wednesday without a second thought, but I believe Wednesday was the most significant day of the week. Thursday, January 23rd, brought some excitement back to the surface. Silver pushed higher during the London trading session, then pulled back when New York opened. This tug of war between trading centers frustrated many traders, but it revealed something important about current market structure. When London and New York push in opposite directions, it tells us that neither side has established clear dominance yet. The market is searching for direction. Disagreement between major trading centers often precedes resolution, and resolutions after prolonged disagreement tend to be decisive. Friday brought us to today, and silver closed the week in a position that creates interesting scenarios for next week. But I have not even told you about the 4 specific developments that went completely under the radar this week. Let me walk through each one because together they paint a picture that surface-level price watching could never reveal. The first development involves commercial positioning. Commercial traders include producers, refiners, and industrial consumers of silver. These are entities that actually handle physical silver in their business operations. Their positions, reported in weekly data, provide insight into how knowledgeable insiders view the market. This week, commercial short positions decreased slightly while commercial long positions increased slightly. Now, I must be careful here, because I'm not suggesting this represents a dramatic shift. The changes were incremental, but direction matters more than magnitude when it comes to commercial positioning. And when commercials reduce short exposure and add long exposure simultaneously, even modestly, it indicates a subtle change in their market outlook. These are not speculators making bets. These are businesses that understand silver supply and demand better than almost anyone. The second development occurred in the physical market. Specifically, the spread between spot prices and near-month futures contracts tightened this week. This spread is called the basis, and it reveals immediate supply and demand dynamics that futures prices alone cannot show. When the basis tightens in the manner it did this week, it typically indicates strengthening physical demand. Buyers of actual metal are becoming more aggressive relative to sellers. You will not read about basis movements in mainstream financial media, but professional traders monitor these spreads constantly because they often provide early warning signals. The third development was a correlation breakdown between silver and the US dollar. Under normal circumstances, silver and the dollar move inversely. Dollar strength typically pressures silver lower, and dollar weakness typically supports silver higher. This relationship is not perfect, but it is consistent enough that traders rely on it for positioning decisions. This week, I observed multiple instances where silver held firm or even advanced during periods of dollar strength. When established correlations break down, it demands investigation. One explanation is that new buyers are entering the market who are less sensitive to currency fluctuations. This often points toward industrial or strategic accumulation rather than speculative trading. The fourth development appeared in the options market. Open interest in silver call options increased this week. But what caught my attention was the strike prices where this activity concentrated. Retail traders typically buy far out of the money calls, essentially lottery tickets with low probability but high potential payoff. The activity I observed this week concentrated in strikes that are actually achievable within reasonable market movements. This pattern suggests institutional participation rather than a retail speculation. Institutions do not buy lottery tickets. They buy options with realistic probability of profit. Now let me explain the technical picture because the current setup demands attention. Silver has been forming a symmetrical triangle pattern on the daily chart over recent weeks. This pattern features converging trend lines where successive highs are lower and successive lows are higher. The market is compressing into a tighter range over time. Symmetrical triangles typically resolve with breakouts in the direction of the prior trend, though exceptions occur. What matters right now is timing. We are approaching the apex where these converging trend lines meet, and breakouts usually occur before price reaches the apex. Based on my measurements, we are approximately 70% through this pattern. Statistical tendencies suggest resolution often occurs between 50 and 75% completion. This means a directional move could come within the next week or two. The weekly chart shows silver trading above its key moving averages with both the 20-week and 50-week averages sloping upward. This indicates the intermediate trend remains constructive. However, momentum indicators display divergence. Price has made higher lows, while indicators like RSI and MACD have made lower highs. This bearish divergence does not guarantee decline, but it signals that buying momentum is weakening and bulls should remain alert. The monthly chart reveals a multi-year basing pattern. When commodities break out of bases that have formed over several years, the resulting moves are often substantial. We are not at the breakout point yet, but we are close enough that this setup warrants ongoing attention. Fundamentally, silver occupies a unique position among precious metals. Approximately half of silver demand comes from industrial applications, including solar panels, electronics, electric vehicles, medical equipment, and emerging technologies. This week, announcements of solar manufacturing capacity expansions highlighted continued growth in one of silver's largest industrial demand sources. Meanwhile, the artificial intelligence revolution continues driving demand for data centers and electronic components that require silver. On the supply side, primary silver production faces structural challenges. Many operating mines have declining ore grades, requiring more processing for equivalent output. Significant new discoveries have been scarce, and deposits under development tend to be smaller than historical finds. The gold-to-silver ratio currently sits at levels that some analysts consider elevated by historical standards. This ratio measures silver's value relative to gold, and extreme readings have historically preceded periods where silver outperforms. I offer this as context rather than prediction. I must address risks because balanced analysis requires acknowledging potential negatives. Dollar strengthening could pressure silver. Hawkish monetary policy surprises could weigh on precious metals broadly. Economic slowdowns could reduce industrial demand. Technical breakdowns could trigger cascading selling. Risk awareness should accompany any market involvement. Here are my observations from this week. Surface price action obscured meaningful developments in volume patterns, commercial positioning, physical market spreads, and options activity. We are approaching a technical inflection point as the triangle pattern nears resolution. The fundamental backdrop remains supportive with solid industrial demand and constrained supply. Sentiment appears neutral, leaving room for movement in either direction. My focus next week centers on watching for resolution of current consolidation. Strong volume breakouts in either direction would provide important information about near-term direction. Thank you for watching Boring Currency Info. If you found this analysis valuable, consider subscribing for weekly updates. Conduct your own research and make informed decisions based on your personal circumstances. Take care, and I will see you next week.